Europe as well. Let's head out to Zurich. David Costa, Dean at Robert Kennedy College, joins us right now. And David, it's interesting because we've got so many factors going on. What should we be paying attention to? Should we pay attention to next week's stress test, or should we pay attention to JP Morgan's warnings?
A very good morning to you, Matty. I think we have to pay attention to a bit to everything, but at the same time, we have to take the important sign. For example, we have seen confidence getting back with the success of the Spanish auction yesterday, and we have also seen a rebounding on Greek banks, given by the possibility of having merge and consolidation in the very fragmented Greek banking market, and even interest of some of the sovereign wealth fund to buy into some of those highly penalized banks. So I still see some positivity in Europe. And I still see there is a possibility for a rebound in the banking sector. And the stress test, I maintain they will have some good surprises. So overall, it might be still a good time to invest in European banks.
It's very nice to hear a positive voice, David. But again, the question here seems to be, are we just not, with all the new funds, that the EFSF, just not recycling the old debt? Are we, taking old solutions to new problems?
Indeed, we're not solving the problem in the short term, but so are not American banks. So between the two, I would still think that in terms of valuation, in terms of value investing, the right buy is more on the European side than the American side. But yes, you're totally right. In the short term, we are a bit recycling the same problems, but it will take time to find a total solution. That said, the market has already priced in many of the bad news, so it might be a good opportunity to enter the market now.
Right, and David, this is Chloe in Asia. You think that commodities are a good place to be, also a good hedge against inflation, but if you take a look at the latest trends in the markets, the strength in the yen, the bond rates, the equities, the markets are factoring more of a deflationary trade.
Yes, but over the long term, I have seen some data recently about pension funds increasing their commodity exposure just as a hedge toward the future inflation. It's not going to happen in the short term, but over the long term, this year the commodities as a whole, they haven't done very well. So again, it's a good entry point if you go to a diversified commodity index, really split into the four main commodity themes and not just focusing just on oil or just on gold. In that way, it's a good edge within an equities exposure at the moment. So I still think commodities toward the end of the year will do better than they did on the first part of the year.
And you also think that, yes, China is slowing, but demand will be strong enough to keep up the commodity space from the likes of India and other emerging economies. Tell us a little bit more about that view.
I think the fact that China is not growing too fast is not to be seen always as the negative point. There is growth, it's still an extraordinary growth, and it's slowing down a bit. Doesn't mean that those commodities are not needed anymore in China or in India, or that supply is more than demand. No. And to that, given that answer, we need to accumulate commodities in a moment where the market is uncertain about the future of commodities and not at the top of the market like we did a couple of years ago. So yes, demand is still strong from China, India and many emerging markets. So buying in a moment where we are lower than last year is still certainly a good entry point.
All right, David, thanks very much for joining us. David's thoughts are always appreciated. David Costa there from Robert Kennedy College. All right, we've got our reporters standing